Welcome to the Lever Trades podcast, where we take a deep dive into both foundation and advanced educational trading concepts. This video is not intended to provide investment advice. All content and opinions shared are for informational and educational purposes only. Trade at your own risk.
Market bubbles, huh? They're kind of like, I don't know, financial legends, right? Well, sometimes they're more like nightmares. We're talking crazy price spikes. Everyone and their cousin thinks they're going to be swimming in cash. Then boom, crash. And let's be real, nobody wants to ride that roller coaster unprepared. So we're diving deep today, figuring out how to spot those red flags, understand what makes these bubbles tick, and hey, maybe even come out on top.
When we talk about a market bubble, what we're really talking about is when the price of something like stocks, real estate, you name it, gets totally out of whack with what it's actually worth.
Yeah.
It's like irrational exuberance, you know?
Oh, I know, irrational exuberance. All right.
Think about it like this. Remember that time you saw concert tickets going for like 10 times the original price? Just because everyone and their grandma wanted to go. It's kind of like that, just with, a bit more money on the line.
So it's like the fear of missing out is stronger than common sense.
Exactly. And a few things can really amp up that fear.
Oh, like what?
Our sources point to things like, well, you've got that classic get-rich-quick mentality. Speculative fever, they call it. Then there's easy access to credit, which sounds good, but it can lead to some risky borrowing. And, of course, there's good old-fashioned overconfidence. And, oh yeah, we can't forget about herd behavior.
Herd behavior.
Yeah, when everyone follows the crowd, nobody wants to be left out.
Okay, so we've got this potent cocktail of human psychology and economic factors all mixed together. It's like everyone's piling onto this tiny lifeboat, ignoring the storm clouds gathering overhead. But what causes those storm clouds to, actually form? What makes a market ripe for a bubble?
Well, that's where it gets interesting. Let's take low interest rates, for example. Now, on the one hand, they encourage borrowing and investment, which can be great for growth. But, and there's always a but, they also make it way easier to bite off more risk than you can chew. Suddenly, everyone's a day trader, leverage becomes a common term, and things can get out of control fast.
So it's like the low interest rates are the fuel and all those other things we talked about, the speculation, the herd mentality, they're fanning the flames.
Exactly. And you know what happens with fire, right?
Yeah.
Eventually, you run out of fuel or reality comes knocking.
And when that happens, boom.
Let's just say the history books are full of cautionary tales.
All right, well, hit me with some of the greatest hits then. Or I guess the crashes that made it into the history books. What are some of the most infamous examples of these market bubbles going bust?
We can't talk about bubbles without mentioning the dot-com craze of the late 90s, right? I mean, the internet was the new shiny thing and everybody wanted in.
I mean, who wouldn't?
The problem was a lot of these companies everyone was pouring money into. They were all potential, no profit. Sometimes they didn't even have a product yet, but that didn't stop people from throwing money at them.
Wait, seriously, they were investing in companies with zero guarantee of making any money. That's like betting on a blindfolded racehorse.
It's that fear of missing out we were talking about. It was everywhere. Everyone else seemed to be getting rich, at least on paper. People didn't want to be left behind. So they just ignored the fundamentals and rode that wave of speculation.
And we all know how that story ends.
Oh, yeah. The wave crashed, the bubble burst, and the NASDAQ, which was, heavily into tech stocks, completely tanked. A lot of those once hyped companies went belly up, leaving investors with, empty pockets and a pretty harsh lesson in how markets really work.
It's like a stark reminder that what goes up must come down, especially when it's built on hype instead of, something real. But it wasn't just tech, right? Weren't there other bubbles that, kind of exploded?
Oh, absolutely. In fact, let's jump ahead to the mid-2000s, the U.S. housing bubble. That one hit a lot of people hard, and not just folks playing the stock market. This is about people's homes.
This is where those subprime mortgages come in, right? The ones that were all over the news a while back. To be honest with you, I was never quite clear on what they were or how they played into the whole dot mess.
It's actually simpler than it sounds. Imagine, if you will, someone gives you a loan, a mortgage. Even though maybe you don't have a steady income or a great credit history, they do this because, you see, house prices are going through the roof. And they figure even if you default, they can just take the house, sell it, and still make a profit.
Hold on, so people are getting mortgages they can't afford, and banks are just like, Handing them out like candy. How does that even...
It was a combination of, well, let's just say lax lending standards. And of course, that irrational exuberance we talked about earlier. Lenders were, well, eager to cash in on this housing boom. And borrowers, they were enticed by the idea of owning a home, even if it meant taking on way more debt than they could handle.
So it was kind of a recipe for disaster.
You could say that.
And that disaster came in the form of...
The 2008 financial crisis. House prices, well, they plateaued and they started falling. Those subprime borrowers, they couldn't keep up with their payments. Foreclosures went way up. And because a lot of these, well, risky mortgages had been bundled together and sold off as investments, the whole financial system just started to unravel.
It was like a domino effect, right?
Exactly,
Yeah.
with consequences felt all over the world.
Okay, so we have two very different scenarios, but they share some striking similarities. That head-in-the-sand mentality, the allure of easy money, and the painful truth that what goes up must come down. But the big question is, can we see these crashes coming? Or are we doomed to just repeat history?
Well, that's what we'll get into.
Wait, hold on a sec. We can't just leave it there. We're talking about potential financial chaos, no time for cliffhangers. So before we spiral, can we actually see these crashes coming?
Okay. Hold your horses. It's not all doom and gloom, I promise. We can't predict the future, not with, like, perfect accuracy. But there are definitely warning signs we can watch out for. First, though, we got to make sure we're clear on the difference between a market correction and a crash. It's not the same thing.
Okay, so like hitting a speed bump versus driving off a cliff.
Exactly. A correction, that's a 10% drop from the recent market highs. Happens all the time. Think of it like the market taking a breather, a healthy reality check. Now, a crash, that's a whole different beast. We're talking 20% or more plunge. That's the kind that usually comes with a recession, and those have a bit more bite.
Okay, so how do we know which way we're headed? What should we be on the lookout for?
It's kind of like a doctor diagnosing something,
Yeah.
You look for a pattern, a bunch of symptoms that together paint a picture. Like one classic sign of a recession is this thing called an inverted yield curve.
Inverted yield curve. Sounds a little, I don't know, intimidating.
Nah, it's simpler than it sounds. Imagine you go to the bank, you want to deposit some money, right? Usually you'd expect to get a better interest rate if you're locking your money up for longer. Yeah, well, an inverted yield curve. That's when short-term interest rates are actually higher than the long-term ones. It's like the financial world turned upside down. Often means folks aren't too confident about the economy's future.
Okay, so that's one red flag to watch out for. What else?
Keep an eye on the unemployment rate. If that starts climbing, could be a sign that businesses are cutting back, the economy's slowing down. And then there's consumer confidence. That's a big one. If people are feeling anxious about the economy, well, they don't spend as much. And that can really put the brakes on things.
It's like this ripple effect, right? One thing impacts another, and suddenly you've got a tsunami on your hands.
Exactly. And we can't forget about corporate profits. When businesses start seeing their profits shrink, well, that's not a good sign. Could mean layoffs, less investment, a whole bunch of problems.
So we're watching for shrinking profits, rising unemployment, consumer confidence taking a nosedive. It's like the economy's got a fever, and the doctor's not looking too happy about it.
Sharp observation. But remember, it's rarely just one thing. It's when you see a bunch of these factors together, that's when you get the most accurate picture.
Right, it's all about connecting the dots. Okay, so those are some of the broader warning signs, but what about those signals that are specific to a bubble? Like the telltale signs that things are getting out of control in one particular market.
Now that's where it gets really interesting. You see, a lot of the same things that cause bubbles, they can also be warning signs, if you know what to look for. Remember how we talked about unsustainable, crazy fast growth?
Yeah, like when a company's stock is doubling every other week, but they haven't actually changed anything about their business.
Bingo.
Yeah.
That kind of explosive growth, the kind that's not built on anything solid, that's usually a sign of speculation gone wild, a classic bubble symptom.
It's like blowing air into a balloon until it pops. There's nothing to support all that hot air.
And then there's leverage. Remember we talked about how easy credit can fuel those risky bets. When you start seeing investors and businesses going into mountains of debt just to chase returns, that's a major red flag. It's like they're betting the farm on a hand of poker.
And when everyone's caught up in the excitement, it's easy to forget about the risks, right? Like that whole herd mentality thing.
Absolutely. When investments that frankly seem kind of shaky or even downright crazy suddenly become super popular, that's often a sign that hype is winning over logic. And that's a dangerous game.
So if it sounds too good to be true,
It probably is. Another thing to keep an eye on is how the media is talking about it. When you start seeing headlines about everyday folks becoming millionaires overnight just by investing in the next big thing, well, that's often a sign that the bubble's getting ready to burst.
It's like the media frenzy just feeds itself, right? Everyone
Boom.
jumps on board, prices go up, and then kaboom.
You got it. The big takeaway here is knowledge is power. When you understand these warning signs, you're less likely to get swept up in the excitement and make those impulsive decisions based on, well, fear or greed.
So instead of freaking out every time the market dips, we need to look for those patterns, the root causes, those warning signs. Knowledge is power, like you said, but how do we use that knowledge to our advantage? What's the next step? That's kind of the million-dollar question, right? We've talked about what causes these bubbles, the red flags, the potential fallout, but how do we actually use this knowledge? Like, how do we not just survive out there, but actually thrive?
Well, that's where understanding these market cycles comes in. It's crucial, really. See, bubbles and crashes, they're not just random events. They're part of how markets work. Like it's like the tide going in and out or the seasons changing, you know. You can't have one without the other.
Okay, so it's not about these things will happen. It's W-H-N. And if we understand those cycles, we can be ready for those ups and downs, right? We can, I don't know, ride the waves instead of getting wiped out.
Exactly. That's the real power of this stuff. Not predicting the future, but making smarter choices, managing risk. When you get what causes those bubbles, you're way less likely to get caught up in all the hype. You can start to see, like, maybe this asset's overvalued, or, hey, this is just speculation driving the price, not anything real. You can avoid those, FOMO decisions that you regret later.
So take a step back, see the bigger picture. Don't let your emotions run the show.
Exactly. And remember, knowledge isn't just about protection. It's about opportunity. A lot of times the best opportunities pop up, not during those crazy times, but during those market shakeups. That's when prices line up with actual value again. By understanding those cycles, by seeing those warning signs and knowing when to pump the brakes a little, you can actually use those chances to your advantage. Buy low when everyone else is freaking out,
Yep.
Make smarter choices for the long haul.
So have a plan, stick to it, and don't let all that market noise drown out your own good sense.
Couldn't have said it better myself. It's about becoming a student of the market, understanding how it works, and using that knowledge to make decisions that, actually get you where you want to go financially.
This has been an awesome deep dive. We've gone from the psychology of market bubbles to actual economic indicators, and most importantly, how we can use all this to make smarter money moves.
It's been a pleasure, really. And remember, the best investment you can make is in yourself. Never stop learning, keep asking questions, and never, ever underestimate the power of knowledge when it comes to navigating the, well, let's face it, the often wild world of finance.
Couldn't agree more. And on that note, we're wrapping up this deep dive into market bubbles and crashes. To everyone listening, we hope you found this as insightful as we did. Remember, the markets can be a roller coaster, but with a little knowledge, a bit of caution, you can ride those ups and downs like a pro. So until next time, keep learning, keep exploring, and keep diving deep.